Recently, in 2023, there's been a bunch of changes that have been announced regarding the 401k program. And so in this video, I'm going to fill you in. The 401k is an amazing program that can help you save toward financial freedom and financial independence later on in life for retirement age. But it's very important to stay up to date on all the different updates and rules regarding this program. And you should definitely listen to what I have to say because recently, Warren Buffett reached out to me on TikTok. And if that's not legit, I don't know what is. Anyway, I'm gonna go over 6 different updates that recently have come out regarding the 401k, and these changes will definitely affect your retirement savings. And if you've heard of any other changes or any other advice that you might give to others who are just starting out saving for retirement, go ahead and throw that down in the comment section below. I get a lot of beginners that watch this channel, and it would be awesome to put together a library for them to be able to learn so we can all help each other out to win later on in life. My name's Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. The first huge update is that catch-up contributions are increasing. Starting in 2025, those aged 60 to 63 will be allowed to contribute up to an additional $10,000 per year on top of the $22,500 annual limit in a 401k. Those who are 50 and older can contribute up to $7,500 extra per year. Let's say, for example, one is 50 years old and wants to contribute the current annual limit, $22,500. $22,500 divided by 12 months is $1,875 per month. $1,875 per month for the next 10 years at retirement age or age 60 in an account that appreciates at 10% per year, one would have $358,592. If instead of only contributing the max of $22,500 but also adding in that extra $7,500 per year, they would be contributing $2,500 per month. And for that same amount of time, 10 years, one could expect to have $478,122, which is about $120,000 more at retirement age. And remember that you won't pull out your entire amount at age 60 or the time that you retire. But let's just say that by the time you hit 60, you decide not to put in another dollar. By age 70, your account would grow to over $1 million. I have many clients that have never put any money away towards retirement, and they're now 45 or 50 years old, and they're scared that they're not going to be able to make it. But this shows that with the catch-up increased, you're actually not too far behind, especially if you get started right away. The next update for the 401k is that auto-enrollment in the 401k is required. Many employers will now be required to automatically enroll employees into their 401k retirement plans. The employees then have the option to opt out if they don't want to utilize the 401k option. This is good to know for business owners, but also for those of you that work for a company. If you have ideas or other things that you want that money going to instead of a 401k, just make sure and check that you're not automatically enrolled in one, even though I think that it's a good idea for everyone to have at least some money going towards their 401k. The third one is awesome, and it really goes along with a lot of the things that I talk about, where it's very, very smart for you to have an emergency savings fund, and so this kind of builds one in for you. And this one's all about emergency savings assistance for employees. So out of your 401k, employees are going to be able to pull out $1,000 penalty-free if it's used for an emergency purpose. Generally, a 10% penalty applies to early distribution from retirement accounts such as 401k plans. Withdrawals from an emergency savings account, however, are penalty-free and don't require proof of a qualifying emergency cause. I like this one for the peace of mind, so I really like this update. Update number 4 is that the Savers credit is actually going to turn into a Savers match. And this one is amazing because it allows low-income taxpayers to get a credit for investing in their future. Starting in 2027, the Savers match will replace the Savers credit, changing from a credit paid as part of a tax refund into a federal matching contribution that must be deposited into a taxpayer's IRA or retirement plan. The match program is equal to 50% of IRA or retirement plan contributions up to $2,000 per individual. When we take into consideration that most people are living paycheck to paycheck, or even worse, racking up crazy amount of credit card debt or personal loan debt each month, An extra $1,000 per year into one's retirement account could really be life-changing. This program is going to be able to motivate people to save their own $2,000 in order to get an extra $1,000, making it $3,000 per year. $3,000 per year, or $250 per month for 30 years, could come out to $500,000 at retirement age. If you don't necessarily need this one, but you know a friend or a family member who might benefit, make sure and let them know, and maybe even send them this video. Number 5 is huge, and I get this question all the time, and it has to do with RMDs, which are required minimum distributions. So even if you're in retirement age, and you don't need to take money out of your 401k because you have income coming from rental properties or something else, there's something called a required minimum distribution, which means you have to take out at least a little bit of that money. I found this very helpful chart on bankrate.com that can give you an idea of how much you can expect to take out. For example, if you are 70 years old now and you have $100,000 in your 401k, here's how much you'd need to take out. At age 75, you'd be required to take out $4,385. At age 80, you'd need to take out $5,175. These can be an issue because if you have a substantial amount in your 401k, but you don't necessarily need to take money out and then you have to take it out, you're also now going to have to pay taxes on that money that you brought out, and it increases your income overall, so you might be pushed into a higher tax bracket, and that could be a real mess in retirement age. So sometimes these RMDs will cause so much stress, so it's good to understand when you might expect to take money out and how much that might be so that you can plan for the future. But the great news on this update is that those RMDs are being pushed back. It used to be age 72 and now it's at age 73, and soon it's going to be 75. If you have a 401k, once you reach age 73, you have to start withdrawing a minimum amount every year. The age will change again to 75 in another 10 years. Another update coming is that RMDs are going away for Roth 401ks. So that's just another reason why I really like Roth in whatever version for your retirement accounts. But that's for a different video. Number 6 is for those of you that have student loan payments, so listen up. Employers are now allowed to make matching contributions to an employee's retirement plan based on qualified student loan payments. This is going to make investing even easier for those of you with student loans. And more information on that is coming out, especially with what ends up actually happening with all these student loan payments. But for now, this is solid news. All of these new updates are very important, but even more important is making sure that you're saving in the right way, because most people are not. Most people don't know the options you have within your 401k, or the fact that you can switch out of unfavorable things that your company probably automatically puts you in and you don't even know. Some of these are leading to crazy fees that are going to take away up to $100,000 by the time you hit retirement, so you want to know about this. Watch this video now to fix those mistakes and many others that I see people do all the time when I have my client meetings.